Welcome to the debate. It is February 23rd, 2026, and yesterday was honestly a massive day for macro strategists.
Oh, absolutely huge.
Right. We saw two competing thought exercises hit the wires, both attempting to project the economic state of the world exactly 2 years from now, June 2028. They feed the exact same data into the model, the exponential adoption of agentic AI. But the outputs, well, they could not be more different.
No, it really is a split-screen reality. On one side, you have Michael Bloch's analysis, which essentially argues we are entering this deflationary utopia, and on the other, Citrini Research published a crisis scenario that looks way more like a human intelligence displacement spiral, just fundamentally breaking the global financial system.
Exactly. And that is the central question we are tackling today. Does the collapse of software costs and economic friction lead to a golden age where, cheaper means richer? Or does it sever the fundamental link between production and income, causing demand to absolutely crash? I am taking the boom side, arguing that the democratization of intelligence is a massive net positive.
And I am taking the crisis side, because my argument is pretty simple, honestly. You cannot have a functioning economy if you destroy the primary mechanism that distributes money to people, which is the white-collar job.
Let's get right into it then. Starting with the bull case, the boom scenario. By June 2028, this model projects unemployment at a structurally low 3.1%, with the S&P 500 crossing 12,000. Now, I know that sounds like pure euphoria, but the mechanics are entirely grounded in purchasing power. We aren't seeing massive nominal wage growth in this model. Instead, we see a massive rise in real purchasing power, up 18%.
Which, to be fair, would be the largest gain since the post-war era.
Right, exactly. The thesis is that when the cost of services, legal, medical, administrative, when that collapses, your disposable income effectively skyrockets. You aren't earning more dollars, but your dollars buy vastly more life.
Okay, but that assumes the economy is a closed loop where savings are automatically spent elsewhere. The crisis scenario challenges that physics entirely. It predicts unemployment hitting 10.2% and a 38% market crash by that exact same date. The core driver here is, well, it's what Citrini calls ghost GDP.
Ghost GDP? Break that down for us, because I think that's the crux of your argument.
Sure. So productivity, the actual output of goods and services, that goes through the roof because AI agents are hyper-efficient, they never sleep, they do not make mistakes, so headline GDP looks high. But the velocity of money, how often a dollar actually changes hands, that flatlines. Why? Because AI agents don't buy lattes, they don't take vacations, they don't buy houses. If companies fire humans to buy software, they are removing consumers from the board. It is a vicious feedback loop. Displaced humans spend less, corporate revenue drops, so companies fire more humans to cut costs. You get a supply-side boom, yeah, but a demand-side depression.
See, that is the classic underconsumption fear. But let's look at where that friction is actually being removed. You call it ghost GDP, but I call it the death of rent-seeking. Look at the intermediation layer, companies like DoorDash, or the long tail of SaaS tools like Asana. In the boom scenario, we stop paying a tax on every interaction. Bloch's analysis uses MasterCard as a proxy, which I find fascinating.
You mean the transaction fee compression?
Yes. In early 2027, the market panics because transaction fees are compressing. But what actually happens? Volume explodes. When you remove friction, humans do not stop acting, they act more. The surplus value from those collapsed margins doesn't just vanish into the ether, it transfers directly to the consumer's pocket.
I really think you are underestimating the speed of that destruction, though. It isn't just margin compression, it is moat destruction. In the crisis model, AI agents don't just negotiate lower fees, they route around the rails entirely. An AI agent does not have habitual loyalty to a Visa card or a specific bank. It uses stablecoins on Solana or Ethereum to settle transactions for fractions of a penny, bypassing the 2 to 3% interchange fees entirely. That obliterates the business models of payment processors and banks like Capital One. You're destroying the revenue engines of the S&P 500 way faster than consumers can figure out what to do with their savings.
I would argue that efficiency is a feature, not a bug. But let's ground this in a real human story, because macro numbers can get a bit abstract. Both papers reference a specific archetype, a senior product manager at Salesforce, currently making $180,000.
Right. And in the crisis timeline, her reality is brutal. Her job is automated. She doesn't smoothly pivot. She ends up driving for Uber or doing menial gig work, earning maybe $45,000. This floods the gig economy with overqualified labor, crushing wages for everyone. The optimist says she will just manage the AI, but the reality is the AI manages itself. She is structurally impaired. Her skills are simply no longer scarce.
That is a very static view. You are assuming she stays a worker. In the boom scenario, the minimum viable ambition to start a company drops to near zero. That same product manager doesn't drive for Uber. She uses AI agents to build a niche compliance tool for small healthcare practices, a market that is way too small for Salesforce to care about, but huge for her. She gets 200 paying customers in 4 months. We see 7.2 million new business applications in 2027 alone. She isn't unemployed, she is unleashed. The economy stabilizes because we stop being employees and start being owners.
That is a lovely narrative, really, but it requires capital. And that brings us to the darkest part of the crisis scenario, financial contagion. We have a daisy chain of debt in this country that people don't really see. Look at private credit. These are non-bank loans often funded by life insurance companies.
Ah, the golden age of private credit, as Wall Street likes to call it.
Until it isn't. Take a company like Zendesk. In this projection, they default on a $5 billion loan because AI agents wipe out their recurring revenue from customer service software. When that loan goes bad, the insurers holding that debt take a hit. Regulators like the NAIC, the National Association of Insurance Commissioners, they step in. They force insurers to sell assets to raise cash. It triggers a liquidity spiral. It is not just a tech problem. It is a retiree problem, because that is exactly where the annuity money lives.
I see the risk, I do, but the system is designed to bend. The boom analyst projects private credit loss rates at 3 to 4%. That is painful, absolutely, but it is absorbable. Remember, in private credit, the capital is locked up. Investors can't just pull their money out in a panic, like a bank run. The structure prevents the exact fire sale you're describing.
But you cannot lock up the housing market. These white-collar workers are the bedrock of the $13 trillion mortgage industry. In the crisis timeline, we see defaults from prime borrowers, people with 780 credit scores in places like San Francisco and Austin. You cannot sustain a mortgage market built on $200,000 incomes when those earners are suddenly making $50,000. The math simply breaks.
It only breaks if you look at the income side of the ledger and completely ignore the expense side. In the boom scenario, yes, nominal incomes might dip or flatten, but the cost of living drops much harder. Services deflation runs at 8 to 12%. If your grocery bill, your legal bills, your healthcare admin costs all drop, your debt-to-income ratio actually improves. We see home prices rising in mid-sized cities because affordability is driven by purchasing power, not just the number on your paycheck.
That is a massive gamble on deflation arriving perfectly in sync with job losses. If you are wrong, we get the social unrest predicted in the crisis model. We see Occupy Silicon Valley protests. The labor share of GDP crashes to 46% because all the gains go to the Mag 7 tech giants and the people who own the compute. It forces the government to propose a shared AI Prosperity Act just to keep the peace.
I disagree fundamentally on where the value flows here. The intelligence premium is being democratized, not hoarded. Think about a 22-year-old in rural Arkansas. Suddenly, they have access to medical diagnostics and legal strategy that used to cost $1,000 an hour. That is a leveling of the playing field. The intelligence tax disappears. A small business in Lagos can finally compete with a firm in Silicon Valley because they have the exact same cognitive tools. That is an inequality that is the most progressive economic event in history.
Well, we are running up against the clock, so I will summarize the crisis position. The technology is miraculous, no one disputes that. But the transition speed is the killer. The canary in the coal mine is singing right now in the JOLTS data. Job openings are falling. If the feedback loop of displacement happens faster than humans can adapt, the financial system breaks before the boom ever arrives.
And I will summarize by saying that betting against technology-driven deflation has been the losing trade for 200 years. Yes, the transition is volatile, but an economy where intelligence is abundant and cheap inevitably leads to a massive rise in living standards. The question isn't, will AI disrupt us? It will. The question is, does that disruption make us poor or does it make us free? I believe the data points to a wealthier world.
It really all depends on whether purchasing power can outrun income destruction.
Precisely. We urge our listeners to watch the data closely as 2026 unfolds. Thank you for joining us on The Debate.